So you're thinking about buying a home, yeah? Well, you've come to the right place. Today, we're going to dive into the world of buy-down mortgage rates. What are they? How do they work? And the big question, are they even worth it? And don't worry, I'm going to break it down in simple terms that even your 5-year-old can understand. But before we jump in, if you enjoy learning about all things real estate, from educational content to Bay Area home tours, do yourself a favor, hit that subscribe button and turn on the bell notifications because you do not want to miss out on what's coming up next. What's up guys, Shar here. Welcome back to my channel. And if you're new, welcome. I'm so happy to have you here. And I would really appreciate it if you could subscribe to my channel where I talk about all things real estate, from educational content to gorgeous Bay Area home tours. Now, this video is a more in-depth version of my previous video that I posted on how to lower your monthly mortgage. So if you guys are ready, let's go ahead and get started. As we know, interest rates have gone up a lot lately, making it harder for people to afford homes. And that's where the 2-1 buy down program comes in. We'll talk about whether you should consider using it, its pros and cons, and other options you might want to consider. I'm also going to be leaving a link to a free 2-1 buy down calculator in the description box for you and your realtor to crunch up some numbers. Before we dive deeper, let's quickly chat about the two main types of loans and how interest rates affect them: adjustable rate mortgages, or ARMs, and fixed rate mortgages. The most common one is the fixed rate mortgage, where you get a loan for a set period, like 30 years, at one interest rate for the entire life of the loan. So let's say you get a loan at 7%, that rate stays put until you pay off the loan entirely. Now, adjustable rate mortgage basically starts off with a fixed interest rate for a few years. For example, in the 5-1 ARM, your rate is fixed for the first 5 years at, let's say, 6%. But after that, it changes every year depending on what the market is doing. On the flip side, you've got something called a buy down. It's a fixed rate loan that kind of imitates the adjustable rate mortgage, but only for a short time, like a temporary buy down. So imagine a regular loan with a 7% interest rate from year 3 to 30. But with the 2-1 buy down, it's 2% lower in the first year, making it at 5%. In the second year, it's 1% lower, so at 6%. And then from year 3 onward, it's back to 7%. So basically, in an ideal scenario, the buyer or the buyer's agent negotiates this money from the seller or the builder to temporarily lower their monthly mortgage until they can refinance later when the rates go down, or till it switches back to the higher 7% rate payment. Now, when you're buying a house, you work with the buyer's agent. They're the ones representing and helping you throughout the whole process. If you want to go for a 2-1 buy down, you can ask the seller or builder for a credit in the purchase contract. Let's say you find a house that you really like and you want to purchase it for $1.5 million, but you also want to go for a temporary 2-1 buy down. This way, you'll have lower monthly payments at the start, kind of planning for refinancing in the future, or if you expect the interest rates to go down. If the seller or builder agrees, the credited amount goes to your lender and they keep it in a separate escrow account. After that, your lender only charges you the monthly payment based on the lower interest rate for the first 2 years. They use the money from the escrow account to make up the difference. So basically, the seller or the builder is helping you out with your first 2 years of payment. Here's how it works. Let's take a look at this 2-1 buy down calculator together. I'm going to also link it down below so you and your realtor can easily play around with some numbers based on your own goals. Okay, let's say we're buying a house for $1.5 million. In this part, we check out the loan amount, and to avoid paying for that private mortgage insurance or PMI, let's go ahead and make a 20% down payment, which is $300,000 upfront. Now, let's take a look at the interest rate. And these are just examples, okay? So let's go with today's national average rate of around 7%. So we can crunch up some numbers. Check this out. Your monthly payment on your first year will drop to $6,442, saving you $1,542. And please keep in mind that these numbers, they don't cover property taxes, insurance, or HOA fees. They're just principal and interest payments. That's it. Now, in the first year, you'd pay $6,442 per month based on a 5% rate, which is 2% less than the note rate of 7%. Moving on to second year, the payment goes up to $7,195 per month at a 1% dip from the note rate. This will save you $789 on your monthly payment. From year 3 to 30, for the rest of the loan term, the interest rate stays put at 7%. That means a regular payment of $7,984 per month. See, if you're aiming for that $1.5 million home, the current $7,984 payment might be a struggle due to high interest rates. But if you expect interest rates to go down in the future, especially if the Feds handle the inflation situation, it's likely that those rates will drop again. So in that case, you can refinance and get a lower interest rate. Start off with the $6,442 payment for the first year and then bump it up to around $7,195 in year 2 and then work out a new deal. Now, some people are going to have questions about refinancing before year 3. What's going to happen then? Let's go ahead and take a look. Let's take a look at this table. In the first year, you don't have to pay $18,501. And in the second year, it's around $9,468, which adds up to a total of $27,970, which will go into an escrow account. Basically, we need the seller or the builder to cough up $27,970, which is like 1.86% of the purchase price. Now, if you refinance within 2 years, you can actually get the remainder money in escrow back. So say you refinance after 14 months, you'll still have $7,890 in the escrow account that you get back. You can use that to knock down your new mortgage rate or pay some of the closing costs. There's also a breakdown of the monthly payments at the end of this page. Also, remember, there are restrictions to this program. You can't use buy-downs for things like buying an investment property or refinancing to take out cash. Plus, different types of mortgages like FHA and USDA loans have their own rules about buy-downs and when they can be used. Also, generally, a FICO score of 680 is needed, and it's important to qualify based on the note rate, even if the interest rates are lower in the early years. In this example, even though the payment in the first year is $6,442, we must qualify based on a monthly payment of $7,984 according to our debt-to-income ratio. Now, there are a couple of other options that aren't as common. One is called the 1-0 buy-down or 1-0 buy-down, and the other one is 3-2-1 buy-down that work in a similar way, where the 2-1 buy-down means the interest rate is 2% lower in the first year and 1% lower in the second year, and normal from the third year onwards. With the 3-2-1 buy-down, the interest rate decreases by 3% in the first year, 2% in the second year, and 1% in the third year, and stays normal from the fourth year and on. And the 1-0 buy-down lowers the interest rate by 1% in the first year and keeps it normal in the second year. Not many people go for these options, especially the 3-2-1 buy-down is more expensive because it requires the seller to make bigger concessions, which will affect your bargaining power and your offer. Let's check out some other choices when it comes to asking the seller for money. Instead of a temporary buy-down, you can use the funds to cover closing costs. These costs include things like appraisals, insurance, title searches, recording fees, and property taxes. There's another way to lower your mortgage rates. Instead of a buy-down, you buy points by paying a lump sum upfront, say $28,000 to lower your interest rate for the entire 30-year term. Here's the big question. Is it even worth it to buy down points? The answer to that question is if the seller or builder is paying for it, then of course, yeah, duh. But if they don't, then timing is everything. If you're not planning to stick around in that home for at least 5 years, and if you're paying for it out of pocket, then buy down won't really save you any cash. But if they chip in, then you can save money on interest during the first part of your loan term. And then it would be worth it because you can always refinance later. You can also look into adjustable rate mortgages or ARMs, but before considering this, make sure you know what you're getting into. ARMs have interest rates that go up and down with the market, which means they can go much higher than fixed rates, but they can also go lower. It's a strategy mainly used in markets where affordability is a challenge, kind of like our current market. The important thing is to make sure you can comfortably handle the long-term payments. The initial savings period is mostly a strategy, especially if you expect interest rates to go down. At the end of the day, you just don't want to rely on lowering your monthly mortgage by utilizing a program like a 2-1 buy down. You also want to make sure that you're getting a fair price for the home to begin with. If a $1.5 million house with a monthly payment of $6,500 for principal and interest sounds tempting to you, double check if the house is actually worth the price. Talk to a real estate agent professional and get a comparative market analysis report, and don't get fixated on just the monthly cost. All right, guys, that's it for today. I hope you enjoyed this video. If you did, please go ahead and give me a big thumbs up. And if you haven't already, please consider subscribing to my channel and turn on the bell notifications so that way you don't miss out on my future home tours and expert insights. And if you're in the market to buy, sell, or invest, please visit my website at listwithshar.com to schedule a free consultation with me. I'm here to help you in any way that I can. Until next time, have an amazing day. Bye-bye.